Hey everyone, and welcome to today's Explainer. Today we are totally demystifying the stock market. We're going to strip away all that confusing noise and intimidating jargon and look at the absolute foundation of how this whole system actually works. By the end of this, you'll have a clear, actionable blueprint to navigate the whole shebang.
I mean, think about this for a second. Billions of dollars move through this ecosystem literally every single day. This isn't just some abstract concept happening in a vacuum, right? The stock market is a massive, living arena that, frankly, creates millionaires. Now, yeah, it's also a place where people can lose money, but importantly, it's the primary tool that everyday folks use to build genuine, long-term wealth and financial freedom. It is a wildly powerful system, and understanding it, that is step one to unlocking its potential.
So here's our quick roadmap for today. 1. What is the market? 2. Why sell shares? 3. Making money. 4. Price movements. And 5. Investing versus trading. Let's get right into it.
Section 1. What is the stock market? The giant marketplace.
It's the question everyone asks, but honestly, so few people ever get a straight answer to. You hear it on the news every single night. The market's up, the market's down, but what actually is it that people are interacting with?
So the crucial point is this. A stock, or a share, by the way, those mean the exact same thing, is simply a piece of ownership in a company. When you buy a stock, you aren't just buying some digital token or a meaningless piece of paper. You are becoming a literal, legal, albeit very small, owner of that actual business. Just think about industry giants for a second. Apple, Amazon, Tesla, Microsoft. We use their stuff every day, right? But the stock market is where you get to stop being just a consumer and start being an owner. As these companies grow their margins and bring in revenue, the value of your tiny slice of ownership scales right along with them. It's like having a piece of a giant pie that just keeps getting bigger.
Section 2. Why companies sell shares? Raising money.
Now you might be wondering, why on earth would a company like Amazon or Tesla want to give up pieces of their ownership to the public? Well, to raise money. If a company wants to aggressively scale up, build out new infrastructure, fund research, or just generally grow way faster, they need cash. Now sure, they could go to a bank and take out huge, crazy expensive loans, or they can just sell shares to the public. It really is a win-win system. The company gets the capital it needs to grow, and we, the investors, get a chance to benefit if they become more valuable over time.
Okay, let's dive into this next part. Section 3. How investors make money. The mechanics of profit. So, how do we actually make money here? There are two main paths to profit in the stock market: stock price growth and dividends. Let's break both of those down real quick. And this simple math brilliantly illustrates the first path: stock price growth. Say you do your research and buy a stock at exactly $100. Later on, the company's valuation grows and you sell it for $150. Boom, you've captured a $50 profit. The price went up after you bought it, and you get to keep the difference. The second path is dividends. Now, a dividend is essentially a regular payment where certain companies turn to you and say, hey, we made a lot of profit this quarter, and since you're a part owner of this business, we're going to share some of that cash directly with you. This is incredibly powerful stuff. It means investors can earn passive income just for holding on to certain stocks. You don't even have to sell the share to make money. The company literally just deposits a piece of their profits right into your account. Okay, let's take a breath and slow down for just a second here. Because as much as we all love talking about profits and passive income, we absolutely have to look at the other side of the coin. Investing always involves risk. Always. Just as stock prices can go up, they can for sure go down. If a company struggles, the value of your share decreases. There are zero guarantees out there, which is why understanding exactly what you're doing is absolutely vital. Moving on to Section 4. Why stock prices move. The invisible hand. Ultimately, it all boils down to basic economics 101, supply and demand. It really is that simple. If a company announces some totally groundbreaking new product and demand surges, the price goes up. On the flip side, if bad news breaks and suddenly everyone wants to sell their shares rather than buy them, well, the price is going to fall. But what's actually driving that supply and demand day to day? It's a massive, complex web of external factors. Prices are constantly pushed and pulled by actual company earnings, breaking news, shifting interest rates set by the government, the overall health of the economy, and even totally unpredictable global events. All these real-world inputs flow directly into the market and decide whether people are hitting the buy or sell button. Now, what's really fascinating here is the human element.
The market isn't just some cold, calculating machine, right? It's heavily driven by human emotion. Investor emotions dictate supply and demand just as much as a spreadsheet does. Sometimes markets drop dramatically based on pure fear and panic. Other times they just skyrocket based on sheer excitement and optimism. Always remembering that there are emotional humans behind those billions of dollars gives you a massive edge in understanding why prices behave the way they do.
Section 5. Investing versus trading. Choosing your strategy.
You know, a lot of people use these two words like they mean the exact same thing, but they are vastly different strategies. Investing usually means buying stocks for the long haul. We're talking holding them for years. Long-term investors look for strong companies, consistent growth, and they love using things like index funds. Trading, on the other hand, is all about the short term. Traders are glued to stock charts, hunting for visual patterns, and trying to master market timing to grab quick profits.
Both of these strategies are totally valid, and you'll see both utilized in the market. But as our source material wisely points out, beginners usually start with investing. Taking that long-term approach with strong fundamental companies is generally the absolute safest way to learn the ropes. It keeps you from getting swept away by the fast-paced, highly volatile charts of a short-term trader.
Look, the stock market might seem super intimidating at first glance, but as we've seen today, at its core, it's really just a system where people invest in businesses and try to grow their money over time. I want to leave you with this incredible, provocative thought from our source today. Learning how it works can completely change your financial future. So now that you have the blueprint, you know what a stock is, why prices move, and how to actually make a profit, how will you use this knowledge to change your own future? Think about it. Thanks for hanging out with me for this explainer, and keep learning.